Okay, so we've got two questions from Noob Investor this week. They were quite interesting because they're all about price targets. The first question is, what fundamentals do you use for price targets? Often you say like you like stock X at certain price, and he's just wondering how X is calculated. I don't think we actually do say that, do we? We don't actually come on here and say I like this stock at this price, do we?
I've definitely said I would like something if it was cheaper quite a lot. There may well be times where I've said how much cheaper. I can't think of any offhand. You're right about that, Paul. But definitely it's been the case where I've looked at something and said I don't like this priced here. And I liked it a lot more, I don't know, 2 weeks ago priced at whatever it was. And that's partly just because the number from 2 weeks ago is lower than the number today. So, yeah, obviously I like it better at that number than this number, right? Who doesn't? But I think this is a really good question for what it's worth, because we do talk about kind of numbers a little bit, and you often hear when you kind of listen to bigger investors than us sort of talking about fundamentals and valuation and saying, well, look, it's about what you pay and what you get, and they never give you any idea really of how to calculate that, partly because it's not in their interest to do that, otherwise everyone would be crawling all over the stocks they want to buy, and that would push the prices up on them a bit. And the other reason I think it's a great question is because I don't have a fixed answer. So it kind of comes down to the what you pay and the what you get of it for me. But there's a good reason why I can't tell you, look, I just read this number and this number and this number on the balance sheet and then add these two together and divide them by this other one. And if that number is bigger than 6, buy the stock. There's some rough ideas I can give you to kind of help, though, right? I mean, Charlie Munger has this really nice thing that I think a lot of value investors would do well to listen to, right? Where so he says, we don't have this kind of formula where if anyone could get rich if they could just punch the numbers into a calculator and press equals or something like that. Because different companies work in different ways. But assuming what you're looking at is not a bank and not a utility, I would try and work it out something like this. I would try and work out how much you're going to have to pay out and the debt you're going to take on. So I would take the market cap, add the debt to it and take off the cash, basically. So I'm thinking, look, if I bought this business, I would have all of this debt as a liability and I would have all this cash to go and deal with it. And that will generally give you a number, and that's how I roughly think about what I'm trying to pay. And then I will look at a number, assuming it's not a bank or a utility, which will probably be free cash flow, and I would treat that as a rough return. So I will say, look, free cash flow is 6% of the number I basically quoted is enterprise value, if you like the names of these things. And I will view that as a return and then try and work out, look, do I think that number's going up or down or the same? And what does that imply about my kind of return, one way or another? If it's a bank, just very quickly, that's tricky because debt isn't the same thing for a bank as it is for a different company. That's what they use to make money. So what I would do there is try and compare the price to book to the return on equity. So how many times equity you have to pay versus the return you get on it. And if it's a utility, free cash flow is a different matter there because their free cash flows are nearly all negative because when they report them, there's a difference between what they call growth capex and maintenance capex, and you have to go digging through their kind of report to figure out which is which to get the right number for free cash flow there. So leaving those two aside for a moment, those are longer projects for another day when we talk about stuff in more detail. That's broadly how I think about valuation, at least for mature businesses anyway. Something like an enterprise value, something like a free cash flow number, making sure that I don't think there's anything particularly weirdly skewing those numbers, and that's how I kind of figure, look, is that return 6%, 2%, 8%, whatever it is, something I think is attractive? If yes, buy it. If no, don't buy it.
Yeah, so mine's a little bit different to Steve's in that I run basically a modified version of Damodaran's spreadsheet for my valuations. So I'm looking at modelling growth rates, and I usually use on younger companies a net margin that's based loosely off its competition. If I'm looking at something that I don't actually follow or don't model myself, I'm generally just running off a multiple of gross profit for a young company, for a company that's free cash flow positive. I'm looking at free cash flow, a multiple of that, and obviously earnings for a mature business. So I'm trying to be fair most of the time. I've spent a lot of time reading Damodaran and watching Damodaran and learning how to use his spreadsheet, and he's got a saying that everything has a price, essentially, and I try to look really hard sometimes to find the value. So the thing I hate the most is when you see somebody come up and say, I can't get this price to anywhere near 130. It's 40, and you think, no, it's not going to be that far out. I'd like to. And I like to work hard to figure out where the value is. So, for instance, just as an example, we were talking on the Discord yesterday about Disney, and somebody was saying, "Oh, we're paying, there's no EPS growth in Disney even after these earnings," and I said, "Well, yeah, but you've got to factor in the fact that Disney are actively spending a massive chunk of cash on content at the moment. So EPS is just not a figure that they care about at the moment. They don't give a flying shit about what their EPS figure is. So judging them off something like their EPS is probably not what they want you to judge them on. So you've got to find the metric that they are, or you've got to modify the EPS to figure out what that figure would be if they weren't just throwing all of the cash they generated onto content. So you could do something like you could take Netflix's margin and you could apply Netflix's margin to Disney Plus, add Disney Plus onto the rest of the Disney business, and then you will get an EPS which you've modified to find probably what's likely going to be a more fair result. So that's what I'm doing. I'm heavily into looking at the data and adding bits back in to try and find where the value is in a company. And I don't always get there. There's a lot of times I've gone to Steve, like with Palo Alto, and gone, how do you get to 500 on Palo Alto, Steve? Because I'm at like 120 and I just can't get anywhere near it. We very rarely get anywhere near it. But there are companies like that. But I don't think, when I watch Everything Money and they tell me everything should be a third, I don't believe that.
Yeah, and for me, I just look at YouTube and do exactly the opposite.